Look,
Yeah.
I actually do.
What were you gonna say, Alex?
No, I'm great to be here. Excited to do this with you, Joel.
Well, Alex, it's been a long time coming. Excited to have you on the show, and it's been fun just being friends with you over the last couple of years. So, glad I got to see you a couple of weeks ago, and I think, look, a lot of the things that we've already spoken about between you and I think it'd be really valuable to just share with the community. And I think, look, I've learned a lot from you over the years, so honored to have you on the show. So just for the viewers, we've got Alex Edelson from Slipstream, a longtime friend. He's supported a lot of the fund managers in our community, and also LPs. So super talented, experienced person. So excited to learn from you today, Alex, and welcome to the show.
Oh, thanks for having me. I don't deserve any of that, and I've learned a lot from you over the last few years. I'm grateful that you would even think of me for this. So excited to dig in.
Well, pleasure's mine. So let's just jump right into it. So I want to start with your backstory. So, where did you go to school? What did you study? What did you do early in your career? And then we're going to talk about how you launched the firm and, what was going on in your head? Why did you even launch the firm? So let's start with that and then just see where the conversation goes.
Yeah, awesome. So from Michigan, went to Michigan undergrad, went to Michigan law school, spent 7 years practicing law, tried to get out of it for many of those years, finally got out of it, joined a friend who had a 2-year-old fintech startup, sort of charitably offered me an opportunity to join him. Company didn't go as we hoped. And then I was really lucky to find a landing spot at QED, an early stage fintech focused venture firm. I joined during Fund 5, started as Nigel Morris's chief of staff. He's the managing partner there and had previously been one of the two founders of Capital One. And so I thought like great opportunity to learn from him and great place to learn generally about venture and startups. I started as his chief of staff, later became the COO and general counsel, and was just there at a really unique time. We were coming out of an emerging manager stage, and the first 3 or 4 funds at QED were really high performing, and QED was starting to grow a bit in Fund 5, and being able to watch QED and be a part of that transition from an emerging manager to an established manager, even though like I said we didn't use those words, that's what was happening.
Yeah.
And it was a great education for me into venture. And that led to like learnings there led to starting Slipstream.
Got it. And what was going on in your head in terms of the decision to launch a fund? I mean, it's a big decision, right? I mean, there's a lot of logistical things you need to think through, financial things you need to think through. It's probably scary in the beginning to actually decide to do that. So, very quickly, I just love to hear what was going on in your head.
Yeah,
When
I
you
you
made
know
those
what I
decisions.
no, it's a great question. And I was just thinking about like, what edge do I have? And like
Mm-hmm.
you
Yeah.
think about like I spent a lot of time thinking about like what is QED's edge and
Mm-hmm.
how do we build on that? And but it was like, what's Alex's edge? And one thing I was noticing, well, I just had these observations about venture. I'm happy to get into this stuff. And I felt like, actually I am in a pretty good position to invest in small early stage venture funds. I think I have a different perspective, and I had
Mm-hmm.
learned a lot at QED about what a good early stage venture firm looks like,
Mm-hmm.
and I had learned a lot both from the team at QED, but also from the founders. Like we were getting founder
Yeah.
feedback regularly. We had it going back 10 years when I showed up, and I was involved in collecting that when I was there. And we had over 150 companies at the time, so it was a lot of rich feedback. And so you're getting this perspective from the team about what a great early stage venture firm looks like, and you're
Mm-hmm.
digging in and you're talking about sourcing or picking or winning or adding value or how to get liquidity or portfolio construction, and just like generally the qualitative characteristics that top early stage VCs have. And then
Yeah.
you're hearing it from some amazing founders, and it's like a high enough volume of founders that it feels
Mm-hmm.
representative. Um, and so you're sort of building a framework for like what's a great early stage venture. But then
Yeah.
then there were other observations like, hey, we're working with smaller funds. Like we're working with these emerging managers. We're sourcing deals from them. We're partnering with them in a variety of ways. And was so interesting. It was like, if you just applied some of the framework that, I guess was developing in my head about what a good early stage venture firm looked like, you're like, hey, these are the ones we think are really good. Like these seem like they could generate excellent returns. You know, my beliefs about their quality did not always correspond to their ability to fundraise. But if you fast forward like 5, 6 years and you look at how those funds have performed, you're like, oh, actually, like, no, maybe we had a framework for thinking about those that were right. Maybe I have some insight into how to evaluate funds like before they have a track record, when it's really just qualitative characteristics that you can test for. So that was an observation. And another was like, if you're going to test for those, the only way is to get sort of real feedback from founders and other VCs, both at the same stage, but actually primarily at the next stage. And so you have to know those folks, or at least know how to talk to them and get real feedback from them. And so it was like an observation that, one, maybe I have a framework here, and maybe I am in this small community of folks, such that I can test for this. And that was really interesting. And then, there were other things that were happening, like, some of these folks, some of these smaller funds like wanted to talk to me, and I just felt like such an imposter. I was like, I'm a lawyer, like I can't help you. I was like, you started a venture firm, like you must know what you're doing, and they do, and I mean many of them do. And
well, I mean, I'd say to address that, we've all felt like imposters, right? I was a tech operator, and I was trying to make my way through getting into venture. And look, if it makes you feel better, look, David Rubenstein from the Carlyle Group was an attorney, right? So some of the best fund managers come from all walks of life, and there's a lot of them that come from a professional legal background, and like those skills really help. Like you do the job, whatever it is. If you're a creative person, or if you're really good with, legal frameworks, you got to lean into that.
No, I think that's right. It's funny. I don't want to turn this into like a legal conversation, but it has been helpful to me in many ways. Although, like, in substance, it's very different than legal work I was doing.
I'm just sorry to cut you off, but I'm passionate just like you. But like, we're gonna talk about learnings. I would say too, I mean, as you know, I mean, there's just so many different experts. So like, even though somebody is a lawyer, you need a specific type of expert that focuses on like fund formation, or you need someone specifically that does IP. So even just being an attorney, like that subset of skills, like is really going to be kind of like that superpower that you can lean into as well, on top of just being an attorney.
It's part of it, but I will say, like, one other part of that, now we're going a little further down the law rabbit hole than may be appealing to people, but yeah, like for me, one thing, I did litigation, and you're constantly learning new areas of the law and new facts, and that is similar to what I'm doing. Like I had to dig in and learn venture. You can go deep, and you can learn fast, and you can be a sponge. You're sort of trained. I felt like I was sort of trained that way. And that does help now. Like, if I'm diligencing a fund, it's like I can go deep fast. I think we're asking good questions and sort of getting to the heart of what's going on in a fund, and getting the most out of diligence. Sometimes, like, I feel badly. I'm like apologizing to people. I feel like I'm like deposing them. Like when I'm like talking to a fund manager or like doing a reference, I'm like, I'm sorry, this is like a little much, but it's just kind of how I think about it. And I think it actually has been helpful.
Yeah. And that helps you be a good fiduciary to LPs, because they know that you're doing the best effort, the most thorough effort possible to, to manage downside risk, right? I mean, you're optimizing for outsized returns, but you're also kind of managing your downside. And, those things like, very detailed diligence, asking the right questions, that could impact, a certain level of basis points of like your return profile. So,
I mean, yeah, hopefully. I mean, I'm so concentrated. My fund's pretty concentrated. And having to get into the slipstream strategy, but right. Like, I'll invest if I can get to conviction. There are some great funds that I'm just not going to get to conviction on, and that's okay. Like, just what matters is that the investments we make are good investments, and that we can get to conviction on those. So
moving to the next question, which is like, how do you determine that conviction, that edge? Like, because we talked about edge, you went through this discovery process of understanding your own edge, right? So how have you mentally thought about, deciding and saying, look, what, this person is now in my conviction phase, and they have that edge, they're special. So like, what was kind of a common thread that you've seen? with these talented fund managers?
Yeah, great question. I guess I think about like sort of talented fund managers and talented investors as slightly distinct skill sets.
Yeah.
Obviously, both are important, but like let's start with great early stage investors. So I guess like the thing that comes to mind is like the 5-tool baseball player. I kind of think about it as like the 6-tool venture investor.
Mm-hmm.
And it's like, what does that person need to do at a high level? It's like sourcing, picking, winning, adding value, getting liquidity, and getting portfolio construction right, such that they have enough ownership in winners. And when they have a winner, it can generate great returns at the fund level.
Yeah.
And so that's that to me is a great investor. And what does it look like? I actually typically don't break it down that way when I'm doing my own diligence. The way I'm thinking about it is, first of all, threshold issue number one, portfolio construction, like enough ownership to generate great fund level returns if they have, if they invest in great companies. Okay, second thing is something unique, some unique competitive advantage, and that is unique to the team, and it is durable or sustainable if the team executes at a high level. So you could say, like, what's their edge? Like, what's so special, or what's their superpower? That's kind of the same issue to me. And, those usually impact sourcing, picking, winning, adding value. In a perfect world, whatever's so special here, whatever edge this firm has, impacts all of those things. And when I say sustainable, I mean like it applies similarly in fund 1 to fund 8 or fund 10. Like whatever's so special here, if you're executing at a high level, it will always be an advantage. So often those relate to things like operating backgrounds at successful, sort of venture-backed companies, domain expertise. It could be some track record at a prior firm of sourcing and winning great deals at a similar stage. Right? Those can help you build an edge, or those can be an edge. Like, I mean, just to give an example and bring some color to it, like QED is a good example. Like QED's team includes one of the 2 founders of Capital One, and others who were very early there. I just don't know of other early stage fintech firms, like venture firms, that have teams like that. And so if you're a fintech founder, man, that's really compelling. Those people get your business quickly. They can help you. They can do things that others can't. And they also may be able to get to conviction on deals that others can't, because they know more about the sector, or they just know more about financial services, and maybe can also help them avoid companies that others might be excited about, but that actually aren't so promising. They don't know enough about financial services, and they have some blind spots. And so if QED executes at a high level and founders are happy and founders are telling other founders about how great QED is, then QED's advantage becomes durable. It's sustained. So that's just one example. But the third thing I'm looking for is like, demonstrated value add to founders, like consistent feedback from founders that this venture investor is really helpful. I hear a lot of talk.
Major.
Yeah, I hear plenty of talk from VCs and founders that like investors aren't helpful. And I think in a lot of cases that's true. That's just not what I'm looking for, because I know, I have sort of lived experience that venture investors can be very helpful. And I know that from even other founders and other venture firms, right? Like we all have our examples of that. That's important to me. That creates a lot of good things for early stage venture investors. The next thing I look for is like, the best investors at the next stage trust this investor. They want to see their deals. They think highly of them generally. Like, I also am interested in what other investors at the same stage think, but it's a slightly different calculus there. Like sometimes there's a little competition, and just other reasons why, like, I'm particularly interested in the next stage investors. And then, people who are scrappy and driven and hungry. It's such a long-term game. It takes so long to go from raising a fund to generating DPI, like distributing capital back to LPs. Like, I'm looking for people who are really hungry, because it's a long road.
Yeah, no, absolutely. I think those are all important facets, and I think the durability just shows that there's repeatability, right? So if they can kind of do the the same. That what can you repeat those 5 things again?
Yeah, I mean, it's portfolio construction.
Mhm.
It's some unique competitive advantage that's
Yeah.
sustainable.
Mhm.
It's demonstrated value add to founders. It's investors at the next stage think very highly of this early stage venture
Yeah.
firm. And it's scrappy, driven, gritty, hungry. Now let's step back though. That's the
Mhm.
answer to the question about what's a great early stage investor, or at least this is how I think about it. But
Yeah.
if you were to say what's a great fund manager,
Mhm.
which I think may have been how you asked it initially,
Yeah.
is like I actually think of it's related, right? You
Mhm.
obviously want to have great returns, but like that is, and that can be sufficient sometimes.
Mhm.
But you also want to be good at investor relations. You want to be transparent. You want to be able to report to LPs in a way that is adequate to them. You want people who know how to sort of thoughtfully grow and build the firm and pick vendors that are going to be good partners to them.
Mhm.
And to the extent they want to have a brand, to do thoughtful marketing and communications. And they know the information to track along the way as they make investments and their companies evolve that may
Yeah.
be actionable to them in the future as they raise future funds or think
Mhm.
about future investments or taking money off the table, right? Like there's a lot more I think that goes into
Yeah.
running a fund than just being a great investor, right?
No, I totally agree. I think running a fund, you're building a franchise, right? You're building a multi-generational franchise. You're building a brand. And, one thing that you said earlier, which was kind of the non-negotiables, like, look, if you just treat founders really horribly, that's not aligned to your values. And I feel like some of the best business people, they have non-negotiables when it comes to values. One of the values is, hey, don't be a jerk. Say what you're going to do, right? So if you have like those guiding principles, those like 5 to 6 core values, that's going to cascade across your team, and that's going to be your DNA. So that way, like as your fund grows to like maybe a mega fund, maybe you don't want to be a mega fund at some point, but there's that kind of franchise level responsibility versus, hey, I'm a good investor. I picked a couple great deals, and we had a couple 10xers. That's much different than thinking more holistically, investing in the brand, investing in the right vendors, all of that stuff. So
No, that's right.
um,
And they're related skill sets, but they're
mhm.
different.
Yeah,
And
it is. Yeah,
you can see great people who are great investors, but like
mhm.
it's not really cut out to run a venture firm. And you
Yeah.
see some people who are like great at running a venture firm, very
Mhm.
professional, but like, you know, for one reason or another, like are not
Yeah.
generating great returns.
Yeah, I mean, solo GPs. I mean, not solo GPs, but solo. I forgot what it's called, but it's essentially just a massive high net worth individual that's deploying capital on their own. Some of those people have done. Their check sizes are the magnitude of like a $30 to $50 million fund, but they're kind of directly investing off of their own balance sheet. So those have been pretty interesting to see. And they're probably great investors, but they probably don't want to, go through the process of doing what you're talking about, firm building, which is, multi-decade long business. But all good points. So, I'm going to move on to the next topic.
Yeah.
So, I've spent some time with you personally, and one of the things that you've told me, which is really great, is just building those true partnerships, those long-term partnerships with LPs. So tell me kind of some of the positive outcomes of that, and then also like what emerging fund managers should do as well. As they're kind of partnering with those LPs, what are some best practices? And to tee this up, I mean, one thing that I've seen a fund manager do is really involve those LPs in their investment committees. Obviously, they're still going to have the final decision making to decide if they're going to invest as a firm, but just pulling in LPs within the process, having inclusion, I've seen that as one thing that I've observed. But would love to hear your take and advice you have to emerging managers to build an engaged LP community.
Oh, that's really a good question. So the answer in my view is well, let's step back. So I
Mm-hmm.
think in the early days, like an emerging manager, and let's include me in this, right? Like I'm a
Mm-hmm.
few years in here.
Yeah.
And like if you would have talked to me when I was just getting started, you're like, hey, Alex, this person wants to invest in your fund. I'd be like,
Mm-hmm.
great, awesome, yeah, let's do it, let's do it. But now it's like, hold on, hold on. These are very long-term
Yeah.
partnerships. And in a perfect world, you're partnering with people who you are aligned with, from a values perspective, who you enjoy spending time with, who are long-term investors in the asset class, who understand your strategy and are excited about it and look at their commitment to you as long-term. That's a perfect world, right? And so I think over time, the hope is that, look, the hope is that before someone commits to a fund and becomes an LP, that they are building a relationship with the fund manager such that each knows what they're getting into and is excited about a long-term relationship. So that's sort of like, it's something that comes to mind now. I think about it increasingly. But yeah, there are other aspects of this question. So I think it starts with building trust, and it starts with doing what you say you're going to do and what you said you were going to do, and being transparent and communicating regularly and openly, and not being too salesy, and saying the good and the bad. Like when things aren't going well in certain dimensions or not as well as you hope, like say it. That builds credibility. It's also, I guess like that aligns with my values, and not trying to gloss over that. And when things are going well, like say it, but be careful, be measured, because it's a long game. But yeah, it's funny. This is one of the evolutions of Slipstream I didn't expect, was that in the early days, most people who committed to Slipstream as LPs in the fund were driven by two interests. One was they wanted the return profile. They wanted diversified exposure to early stage venture funds. They liked the diversification across companies and time and geography and sectors, and that was great. And the second were people who wanted to co-invest. I thought this would generate 20 to 40 co-investments over the next few years, co-investment opportunities over the next few years. And I thought people would be drawn to the opportunity to put more capital into the companies that are breaking out of the funds that we've invested in, like before they're public, or maybe before they're acquired. And so, and that rang true. Those were two driving forces for my early investors. But then there's been a third group of investors with whom I work pretty closely. And they are people who, for one reason or another, heard about Slipstream or were excited about funds we were seeing or investing in, or how we were diligencing funds. And they want to work together to help build out their venture strategy. They want to see more funds. They want to put more capital to work. So like maybe they put a meaningful amount into Slipstream, but they put potentially a lot more into funds that we bring them. And that's often funds that we don't invest in, right? Like some people have certain strategies, and like often if I invest, my LPs will put in more, and often more than Slipstream's investing. And sometimes when I don't invest, I'm sharing the funds with my LPs I think could be a fit for them, and they're investing in those funds. And so I've, over time increasingly worked closely with LPs in that way. But yeah, I just try to stay close to LPs. I try to check in with them on a regular basis, not too frequent. You kind of have to calibrate to like their interest and their career and whether they're professional investors or not. But it's a really important thing, and it impacts like the long-term trajectory of a firm, because if you're keeping your LPs happy and you're doing what you say, chances are hopefully they're going to be back for future funds, and that's real stability. There's value in that stability.
So to piggyback on the flip side of what we look for, and obviously transparency, I want to talk about red flags when you're investing in funds. And you and I have talked about just kind of incongruencies in what people have said or what they've said they've done. So what are some red flags when you've looked at funds that you've observed that maybe emerging LPs should also think about?
So recently, just some things. You and I were talking about people, sort of like name dropping relationships, and it turns out, doesn't seem like those relationships are close, or not sure they exist, or being negative about like certain folks like LPs or GPs, I think can be a little unappealing. Although I think being able to distinguish yourself in like a thoughtful, positive way, I think can be helpful. But being careful with that. I've heard many GPs tell me like success for them is getting a certain size markup at the next round. It's like, hey, if I'm a seed stage investor, like if I get a 2 or 3x markup on the next fund, like in the next round for any given company I invest in, that is success. And it just feels like, success for me is like DPI. It's like getting liquidity out of companies.
Yeah.
And there are a lot of things that need to happen between that markup and the DPI. And so that typically is not what I'm looking to hear.
Yeah. But it's so early, right? You're getting in early where, DPI isn't a topic, but you're thinking about that, right? You're really thinking about, does this firm have the potential to deliver, DPI, and how quick can that happen? What are some red flags in terms of the pitches? So like, when they're storytelling, or maybe when they're talking about, the markups that they have, are people kind of misrepresenting the markups? Like, hey, this is going to be a 10x, and it seems like an exaggeration. Have you seen that sometimes in terms of potential performance?
Well, there's a lot of I guess dispersion in how people are even marking the same company. So like you might see multiple funds that have exposure to the same company that are marking it differently right now. So yeah, like you always want to dig into that. But it's something that I've just seen a lot of this over years now, is just like, not being as thoughtful, I think we would hope, about fund size. Like everyone wants to grow, and not everyone wants to grow. Growing is appealing, and I get it, and that is the natural progression typically. But you want to make sure this is still built around what's so special about the fund manager, and like, can you execute on a fund that's this big? Can you get that much ownership? Like, are you really stretching it now? Like, oh, you need to make more investments. Do you have the team? Do you have the time to be investing in this many more companies? Like.
So it sounds like if I were to digest that, it sounds like based on where they are, they're projecting. I think there's a couple uncertainty points, right? So number one is, can they actually raise that much amount of money, right? So if they say, look, I'm raising a 50 million, an $80 million fund, and my first, took me, 7 months to get to my first close, and we're about like 2 million. There's a low likelihood that you'll probably actually get to 50 million. So the fact that they're presenting that strategy to you, that would probably be a red flag. And then to your point, like if they're a solo GP, and they haven't had, they haven't set up the infrastructure, they don't have actual teams of people to support them, to support actually deploying that capital, that could be maybe a not a good presentation in terms of comparing that to reality of what could actually be executed. Am I digesting that properly?
I think that's right. I mean, it's also just like thinking about what's the right fund size that you can execute on and continue to generate great returns for. But what you're saying is an interesting point. And
I'm saying it's two things, right? So it's, can you actually raise that capital? There's been a handful of funds that have actually cut their goal by a half, because of just the markets.
I've seen,
So that's one piece. But then also, I think what you're concentrating on is just, does it make sense to invest in, does it make sense to invest in 80 companies in a $15 million fund, right? That just doesn't show good thought process around like, the check size and the ownership. I think that's what you're really thinking about too, right?
Well, I'm also thinking about growth between fund sizes. So it's like, hey, we had a $10 million fund, we were getting 1% ownership or 2% ownership. Great. Now we want to go, and that we think that did really well. We've done everything we said we would do, and in fact, so well. We're going to raise a $75 million fund.
Yeah,
we're going to lead rounds. We're targeting 12% ownership. It's like, okay, like targeting 12% ownership on a $75 million fund is actually, that's compelling fund math. But like that's a big jump, and yes, and so there's a lot that any LP needs to underwrite. Like. Can you execute on that strategy? On the strategy that you need to execute on to generate returns for a fund of that size. But you're making an interesting point, and the initial point you made, which is like in this market, it is, very hard, especially for emerging managers, but really everyone. It's a hard time to fundraise.
It is,
and so I am seeing people cut fund size by a third or more, or by 2/3 or more. And if you catch someone if you're talking to someone who's been fundraising for a long time and is not made a ton of progress towards their target fund size, it does become hard, because I don't really know what to underwrite. Like if you're going to adjust it, like then it's like, let's say, there was a fund I was talking to, and it was like, we're gonna do a $50 million fund, and the last fund was like a lot smaller. And I really liked this fund at like a $20 million size. And it turned, like, I couldn't get there on a $50 million fund. And then like 9 months later, it was like, we're doing a final closing on a $20 million fund. And I was like, that is actually good. Now, I passed on this a long time ago, but at a $20 million fund size, it's a compelling fund.
Yeah.
And so, I get this all the time where it's like, I don't really know what to do here if you're closing on a small percentage of your target fund size. You've been fundraising for a long time. I don't even really know what I'm underwriting. So like, should I underwrite you to the target, or should I underwrite you to some other fund size that you will maybe adjust down to at some point? It's hard to manage. So in those cases, I guess I try to be transparent, but I don't want to tell people they're not going to succeed in their fundraising. They very well might. I don't know.
Yeah.
So you can't like make assumptions that they're going to fail to reach their target. So you try to make it a dialogue, but it's tricky.
No, it is. Yeah. So that's all helpful. And I know we got 5 minutes left, so I'm going to rapid fire the last couple of questions. I'm going to kind of combine it a little bit. So,
Sure.
Investing, so LPs, they come from all different backgrounds. They have different strategies, right? A lot of the more institutional LPs have a multi-asset approach. For some of them, venture doesn't even fit in their mandate. Some of them focus on buyout and PE. And then some of them are business families, right? So they come from launching a business, maybe having a couple exits. So they really have been involved as a founder. And those are some of the best LPs too, because they can really lean in and help the founders too with their wisdom. So, thinking about the different types of LPs, what have you learned in terms of the benefits of investing in funds versus for LPs trying to figure it out on their own and go direct? So maybe talk about both of those scenarios.
Yeah, it's great. I mean, I think like people need to think about two things. Like one, like what would they like to accomplish? What's their goal?
Yeah.
And like, what are they capable of accomplishing? Like, do they have the team to accomplish that goal? Do they have the skill set? Do they need to hire people? Do they have the network? Do they have the ability to do the work? And so, yeah, like if you want to do directs, I guess like my question is like, do you think you can source, pick, win? Do you need to hire a team for that? That's really hard. Like as a general matter, especially once companies are into the sort of like post-seed or post-A stage and they're getting to product market fit, like those can be pretty competitive rounds. And, you often see the best deals go to the best venture firms. And similarly, in the early stages, like the best venture investors are typically seeing and doing great deals. And like, will there be an opportunity for you, or are you just going to get adversely selected such that like, it's really not the right strategy here is probably not to try to do directs on your own. But if you want exposure to the early stage venture companies, maybe you get it through funds, and like funds have pros and cons. Like pros are like you get diversification across time and companies and geographies and sectors and fund managers with different tastes and preferences and portfolio construction, and great. But they can also be very high performing. I mean, we've all heard of very high performing funds. But if you put it all in one great company, then you will probably outperform most great funds. And so I can't tell people they should do funds if they think they can get into great companies directly. And then like for a strategy like Slipstream, like you can go to a fund if you feel like you should invest in funds, I suppose, if you feel like you can source and evaluate those. You have the ability to see a lot of them. You can evaluate them. You can get to conviction on them. And you have reason to believe like your framework is right and this is going to work. I see those LPs and collaborate with LPs like that, of course. And then some LPs are like, hey, that's not really my skill set, or I don't want to spend my time that way, but I do want exposure to early stage venture, and I'm excited to get it through a vehicle like Slipstream, where it's more diversified than going right to a fund. Maybe we have a higher floor and a lower ceiling than being directly into a fund, and certainly than going directly into a company. but it's, you know, it's a little safer.
Yeah.
But you can have great returns in early stage venture fund to fund strategy.
Yeah.
So I don't know if that answers your question, but that's what
No,
comes
it
to
does. And then I have something that's going to bridge us to the next question, which I think is, you know, because I'm going to ask you, what have you learned recently, right? So there's a bunch of lessons that you picked up along the way. But one that's recent to me is, it's an interesting saying. Sometimes if you pay less, you actually pay more. So what I mean by that is, obviously, you know, as an LP, you're not going to have to pay fees. You're not going to have to pay a fund manager for the work to diligence deals.
you mean if you're
But
going direct?
yeah, I mean,
Yeah,
so you
yeah,
don't have to pay management fees,
sure.
but you're kind of figuring it out on your own. And you know, there, you know, obviously, depending on how savvy of an investor versus fund manager you are, you might do amazing doing it on your own, you may not. And this is something that I've learned recently. It was somebody that told me the saying. I was working on this project that I'm investing in, and it was a huge bargain to get into the deal. But I realized, hey, I have to invest some more capital, and it actually cost me more, even though I save money on the front end. Like, you know, sometimes you might pay more down the road. So that was just kind of something that, you know, because we're going to be talking about learnings in this final question. You know, that's kind of related to going direct versus investing in a fund. Do you want to pay the premium to kind of have a pro give you really a cool, awesome, diversified strategy and access to amazing outsized returns? Or do you think you're skilled enough to do it on your own and you can kind of forego that? But if you do it on your own and a couple of these deals blow up, it may cost you more down the line. You know, so that was one of my learnings. But I'm gonna, you know, I know we got 1 minute left. We're gonna talk about some of your biggest learnings in the last few months, and we can wrap up with
Oh
that.
yeah, sure. So yeah, I guess these are sort of generally applicable to underlying fund managers and myself,
Yeah.
and to other LPs, some of them at least. One is just like how important it is to be patient. Like
Mm-hmm.
we went through a period there from 2021, part of 22, where like,
Mm-hmm.
you know, we may look back on that and I folks may wish like they were more patient and
Mm-hmm.
they passed on more. And I think funds that were patient over the last few years, they are likely to be rewarded for that.
Mm-hmm.
And I think, you know, like LPs typically don't complain when a fund manager says, "Hey, we kept a high bar. We're not seeing things we like. We're gonna hold off, and we're gonna be patient, and we're gonna play our game. And we're gonna pick our spots."
Mm-hmm.
I don't typically hear LPs complain about that when GPs say that.
Yeah.
Um, Also, just like I've seen a lot of fundraisers languish, like fundraising processes just feels like it's taking a
Mm-hmm.
long time. Fundraising for emerging managers can always has always taken a long time in some cases at least. And certainly in this market it's hard, but you know, some folks who have added some structure to their fundraising process, as long as it's giving people enough time, you can't really create like false urgency and
Yeah.
but if you can create some parameters so that people feel like they have enough time, but they're also, you know, sort of being moved through a process that has
Mm-hmm.
some parameters around it, I think is helpful to get a fund close. It might, the risk is, of course, you don't hit your target and then
Mm-hmm.
you need sort of a minimum viable fund size. And if you hit that, I think you close it and move forward. Um, yeah, learnings for me was one learning specifically for me was just like I didn't realize how many folks were out there who wanted exposure to venture and didn't know how to get it or just wanted to see more funds or wanted help diligencing them.
Mm-hmm.
When I started Slipstream, that was just not a part of my strategy. And it has
Yeah.
become like an important part of my strategy and what I'm doing. I work
Yeah.
closely with families and other groups to try to help them build their venture strategies. It's been a lot of fun for me. And
Mm-hmm.
it's just a learning over time that like there are a lot of people who want this exposure, are trying to get it
Mm-hmm.
in one way or another can like use some form of help. And so that's been fun for me. And it's a part of the business
Yeah, we
that I'm
talked about this too. I mean, some of these families, these, you know, multi-generational families, these wealthy, they have the wherewithal to invest in a tier one VC. You know, they could probably get access through their network into, like, you know, Sequoia or some of these top tier funds. But the value of being with a close partner is really having access, being able to text, you know, an emerging manager, being able to get a little more granular detail and engage a little more versus just kind of like the quarterly report that they get through the investor portal, right? So just kind of having that deeper support and strategy building that you normally wouldn't get with kind of a more off the shelf product. I think that's the huge edge that emerging managers and emerging LPs can really deliver.
Yeah,
So,
no, I totally agree. There, when you're investing in small funds that are early in their evolution, there's a lot of opportunities you can get from that. You can be close to companies, you can be close to founders, you can get co-investment opportunities, you can
yeah.
learn a lot. These GPs might have time to spend with you to talk about what's going on. They can introduce you to other funds and other LPs to build your network and generate other investment opportunities for you. So yeah, it's a cool space in that way too. Just like all the opportunities for investing in these small early stage funds.
Yeah, awesome. Well, hey, Alex, this was amazing. Really learned so much. So appreciate you making time out. I know you're super busy, so it means a lot for you to educate the community and educate me as always. So hope to catch you soon, whether I go to DC or you come out to New York.
Well, thanks. The feeling's mutual. Thanks for having me on, and it's been fun.
Yeah, absolutely. Well, take care, Alex, and catch up with you soon.
Talk to you. Bye, Joel.
Take care. Bye.